Let's get a closer look at bank stocks following a series of downgrades ahead of earnings season, which kicks off next week. Joining us now, Scott Siefers, Piper Sandler senior research analyst. Scott, great to have you with us. At the heart of the downgrades that we've seen so far yesterday from HSBC, the concern really was valuation, that a lot of the good news has been priced into stocks. And I'm wondering how you see, let's say, a JP Morgan, which is close to a record high, trading at a price to book of about 2.4, which is, expensive to itself, expensive, to the group. And how do you justify that moving higher?
Yeah, so it's a good question. It's an interesting time, Melissa. So again, thanks for having me. So, as I think about a name like JP Morgan, we like it. We think it's still the go-to for the longer term. But what's been interesting is the universals, and especially names like JP Morgan, they've outperformed so substantially, especially from the lows that we had with, April's kind of tariff turmoil and everything. So I can certainly understand what we're seeing with a little softness as investors sort of take a breath after that real rebound. But, the fact of the matter is that a name like JP Morgan's really well positioned for the long term. They stand to benefit from this higher for longer rate backdrop. They should be a very healthy beneficiary of a regulatory rationalization. They have just an enormous hoard of excess capital. So they'll continue to be a really good name over the long term, we believe. But certainly understand this little kind of rotation that we're seeing into, say, the regionals out of the money centers, given valuation disparities.
Yeah, I mean, the disparity is great. I mean, regionals are like at 1, are trading at half the multiple. And so, from your standpoint, is there an argument to be made to be going to regionals, or is that group still risky in a market where the second half has some question marks around it?
Yeah, I wouldn't say the regionals are necessarily risky. In fact, there are several names that we like. I would highlight a name like a U.S. Bank, Citizens Financial, Fifth Third, Key Corp, for example. So the story is improving kind of across the board. As I suggested earlier, it's very strong for a name like JP Morgan and the universals. But as we kind of exit this immense amount of uncertainty following what happened early in the second quarter, the backdrop for the regionals is starting to look more like what we had hoped it would be at the beginning of the year or the beginning of Trump's second term. For example, the regionals should benefit really well from a likely rebound in commercial lending demand. They're well positioned to take advantage of an investment banking recovery. The rate environment's pretty benign for them, and credit's kind of a non-factor. So, I think as I look at things, the environment's actually pretty good all around. As I suggested, we tend to prefer the universals over the longer term, but it's a pretty decent backdrop all around in the banking space.
You mentioned higher for longer, and I'm wondering in your mind what that means exactly, since Wall Street is expecting maybe a full point coming off of rates in the next, 12 months, 9 months?
Yeah, good question. So I tend to look at it a couple different ways. Number one, we tend to do our modeling off the Fed funds futures, which is the best indicator we can get for the likely path of rates. And it looks like there will probably only be about 2 rate cuts at the short end of the curve this year. I think as long as we go in a measured pace, that's probably fine. Just as importantly, we look at the shape of the yield curve, which is actually pretty steep. Banks tend to capture that spread between short and long rates, and that's been great. So what we're going to see in the regional space, for example, is that you're going to have this asset repricing story where banks sort of roll off lower yielding assets from a few years ago. Bank of America is actually probably the most pointed example out there, where they had bought a lot of low yielding mortgage-backed securities several years ago. Those will roll off, and you'll see them reinvest in similar securities, but at much higher rates. So there's a good asset repricing story in there. And then even though we're reaching sort of the tail end of it, there are still deposit pricing opportunities. So basically what you're getting are better asset yields, stable to lower deposit costs, and it really helps the net interest income trajectory.